So the US dollar is wobbling and Donald Trump's name is being dragged into the conversation. The question is, could he actually be orchestrating some sort of controlled collapse? At first, it sounds insane, but let's break down why it might make sense from a purely strategic perspective. The United States is under a mountain of debt that it cannot realistically pay off without borrowing more. Trade deficits are chronic and structural, and domestic manufacturing has been hollowed out over decades. A strong dollar has kept imports cheap, Wall Street happy, and Americans spoiled with cheap goods. But it's also been a poison pill for the domestic economy. Factories are closing, supply chains vanish, and workers find themselves competing with a global labor pool that can make the same product for a fraction of the cost. Now imagine weakening the dollar on purpose. Suddenly, US exports aren't overpriced to the rest of the world anymore. Manufacturing, energy, agriculture, and services suddenly become competitive again abroad. Policymakers sell this as reindustrialization, a patriotic rally cry, but the reality is that it only works if the industrial capacity still exists. If the factories are gone, the supply chains are dead, and the workforce isn't there, a weaker dollar just produces inflation without growth. Your latte goes up in price, your rent climbs up, and the cost of living bites even harder. But if done strategically, it could shift global demand back toward US goods. It could also reset trade imbalances and give the country a fighting chance to leverage its resources, its technology, and scale in ways a stronger dollar regime simply does not allow. And that's why, as crazy as it sounds, intentionally weakening the dollar is a tool for system reset rather than simple economic sabotage. It's not chaos for chaos' sake, it's chaos sold as opportunity. And that's the mind twist that policymakers are hoping that the public is going to buy. So here's the thing: if the US government were to do this, they would never admit to it, obviously. Nobody in the White House or Treasury would step on TV and say,
Hey, we're intentionally crashing the dollar.
because that would be financial Armageddon. Capital would flee, investors would panic, and confidence would collapse overnight. Instead, the strategy is all about language, optics, and slow, almost invisible adjustment. So they'll use words like rebalancing, temporary inflation, competitiveness, and systemic adjustment. And these words are deliberately chosen to make the public and markets believe that any pain is brief, it's necessary, and even patriotic. But here's the actual reality: a weaker dollar doesn't impact everyone equally. Debtors, the people and institutions who owe money, suddenly see their real obligations shrink. Creditors and savers holding cash or US debt take a hit. Asset holders with tangible real world items like land, energy, or infrastructure are insulated, often advantaged, while wage earners without bargaining power get hit the hardest. Inflation slowly erodes their purchasing power, prices rise, and everyday life feels more expensive. This is why controlled devaluation doubles as domestic wealth redistribution, punishes the holders of financial claims with while protecting those with real assets, all under the guise of economic adjustment. Politicians can sell it as necessary for competitiveness, reindustrialization, or national strategy. If you follow the money and the rhetoric, you see that it's both a financial reset and political reset. So debt is managed, exports are encouraged, and the system subtly shifts power from passive financial holders to the productive economy, assuming the productive economy still exists. It's messy, it's controversial, and if you're an ordinary wage earner, you're probably on the losing side, at least at first. But that's the point: gradual, controlled, deniable chaos disguised as policy success. The optics are everything, and the strategy relies on people believing they are watching a reset when really the system itself is quietly being reshaped. Now, let's zoom out and see what happens globally. A weaker dollar doesn't just impact Americans, it's a geopolitical shockwave. Every country holding US dollars, so China, the European Union, emerging markets, the global south, all gets hit at the same time. That is part of the appeal if this is intentional. It forces everyone to absorb losses together, making the move a kind of stealth economic weapon. The US can reset its system while allies and adversaries alike pay some of the cost. But here is the danger. If the drop happens too fast, confidence breaks and the strategy unravels. Inflation can spike beyond expectations because capital flees the US, foreign governments and banks refuse new treasuries, and suddenly the controlled collapse becomes uncontrolled. Allies might defect, and adversaries might escalate their efforts to purge the dollar entirely from their reserves, pushing the US into real trouble. There's also the human side. Domestic consumers suddenly feel the squeeze. Debtors will get temporary relief, but ordinary wage workers without bargaining power or assets see their money shrink in value. On paper, the plan could work if executed slowly and stealthily, but it's a tightrope walk. Every misstep could turn a strategic reset into a catastrophic loss of confidence, which is why any such operation would be deliberate, it would be denied, and framed as necessary for national competitiveness. Politicians, economists, and Trump himself would emphasize the temporary nature of inflation while keeping the real motives obscured. And yet, if managed well, a weaker dollar could theoretically reset the US's competitive edge. It could revive global demand for domestic production and reassert economic influence, but only if the industrial capacity still exists to actually produce goods at scale. Without it, the dollar weakens, prices rise, and Americans get the bill without the benefits. In short, a dollar collapse is a strategy that can redistribute wealth. It can reset trade and potentially weaponize the currency globally, but it's a gamble on both domestic resilience and international patience. Let's talk about the immediate consequences for markets and ordinary people because this is where this theory hits reality hard. The dollar weakens intentionally. You might see US stock prices spike at first, and that's because nominal asset values, what the numbers say on paper, inflate. On paper, it looks like a boom. But here is the catch: the money doesn't go as far anymore. Purchasing power declines, inflation spikes, and suddenly everything from food to rent costs more. Savers lose, wage earners lose, but debtors gain. Banks and big financial institutions holding dollar denominated assets take a hit. That's why any collapse has to be stealthy and gradual. Too fast and panic spreads. Imagine people waking up and realizing their bank deposits by half as much as yesterday. Capital flees not just domestically but internationally. Foreign investors rethink holding US treasuries, international companies recalculate their supply chains, and allies start asking themselves if dependence on US dollars is really safe. On top of that, the US government has to maintain credibility. If it loses that, the so called controlled devaluation becomes uncontrolled, and the dollar's collapse feeds on itself. This is the tension policymakers live with. They want the advantages of a cheaper currency like boosted exports, industrial revival, leverage, strategic positioning, but they must carefully manage the timing, the messaging, the market psychology. One misstep, and it's chaos instead of a reset. It's a high stakes game, balancing inflation, confidence, and global perception, all while domestic voters are trying to make sense of the higher grocery bills, the rising fuel costs, and confusing stock market rally. Okay, so now let's look at the big picture because this is where a weaker dollar becomes more than economics. It becomes strategy. If done carefully, a controlled devaluation forces the rest of the world to share the pain. China, Europe, and developing nations holding large dollar reserves suddenly face losses too, meaning the US can reset trade imbalances while spreading the impact. But here is the catch: if other countries decide to purge the dollar completely by diversifying their reserves, shifting to other currencies, or creating alternative trade systems, the US loses leverage. BRICS had better start moving, right? So the system only works if global dependence on the dollar persists, which is why any collapse must be gradual. It absolutely has to be opaque and officially denied. Strategically, it's a weapon disguised as policy. A stronger US export sector, improved competitiveness, and the chance to rebuild industrial capacity, but the risks are enormous. Confidence could crack too fast, inflation could spiral, and even allies might defect or hedge aggressively. We've already started seeing this, though, hey? Domestically, the winners are debtors and real asset holders. The losers are wage earners without any bargaining power, ordinary savers, and creditors. Internationally, the pain spreads to everyone holding dollars, creating pressure points and forcing strategic recalculation. The ultimate irony is this: the US succeeds, it regains economic leverage, industrial strength, and geopolitical influence. If it fails, it accelerates financial instability at home and abroad. So when you hear Trump or any other official talk about adjustments or competitiveness, understand that those are polite words for a highly complex, high risk economic experiment. The dollar isn't just money, it's considered power. And controlling, weakening, or collapsing it, even slowly, is about reshaping who wins, who loses, and who really calls the shots in the global system. It's messy, it's controversial, and maybe the boldest gamble anyone in modern US history could try. But this is the Trump we're talking about, so maybe. I don't know, just maybe.